Welcome back to the Retirement Fiduciary Podcast, a place where we have authentic, no BS discussions about retirement planning, investment strategies, and wealth management. Whether you're approaching retirement or if you've already made work optional, this show is for you. Now, here's your host, Adam Koós, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group at libertaswealth.com.
All right, quick show of hands. How many of you filled out a bracket this year? Now, how many of you already have a busted bracket at this point in the tournament? And here's another question. Be honest. How many of you have actually watched all 64 teams play this year throughout the season? Now, this is the funny part. We all jump in anyway, don't we? Even did it this year. Before we go any further, I have a quick quote for you. I always collect quotes. And Bobby Knight, one of the most prolific coaches in NCAA history, once said, "Most people have the will to win, but few have the will to prepare to win." And that's really what we're going to be talking about today. Not guessing, not getting lucky, but actually setting yourself up to win in your retirement portfolio and drawing lines of comparison between basketball, March Madness, and your retirement portfolio. So there are 63 games in this tournament, all single elimination, and every single year, millions of brackets get filled out. And here's the crazy part. Most people haven't followed these teams at all, but somehow everybody feels like they've got a shot at getting it right. And the reason we even feel like we can do this is because of seeding. So the NCAA ranks teams from 1 to 16 in each bracket, and it's designed to keep the best teams from knocking each other out early. But more importantly, it gives us all a framework and a reason to watch the games. It stacks the odds, supposedly, and it makes it feel like we've got a system, some way to game the system. But here's where things start to go sideways. People fall in love with the Cinderella story. Everybody wants to be the one who called the big upset, the 12 seed over the 5 or the 13 seed over the 4th seed team, let's say. It feels smart. It feels like you've cracked the code. And it might even be a little fun when you're right anyway, but this is actually where most people lose. So let's put this into perspective. A 1-seeded team has only lost to a 16 seed twice ever. I'm going to say that one more time. I'm going to say it in reverse. The 16-seeded teams have only ever beat a 1-seeded team, or in other words, a 16-seeded team had only won their first game 2 times ever. So that's 2 times out of more than 150 games. So yes, upsets do happen, but they are incredibly rare. The odds are overwhelmingly on the side of the higher seed. So when you zoom out and you look at the data, it's not even close. Number 1 seeds win about 80% of their games. And if you back up even further, top 3 seeds win nearly 3 out of 4. Meanwhile, the lower seeded teams barely win at all. And in the end, it's the higher seeded teams that constantly and consistently dominate, period. And that's just how it is. And this is the one thing I really want you to remember, is that the top 3 seeds in the tournament have won 36 out of the last 39 championships. Think about that. If you're trying to win your bracket, the champion is almost always coming from the top, not from the middle, and most certainly not from the bottom. This is why we often talk to our clients about our philosophy being to stay invested in the playoff teams and avoid the rest. I know, different sport, but I digress. All right. I want to stay on this slide for a little longer just so it all sinks in, but you can always hit the pause button or rewind if you want to go back and analyze the numbers yourself. But here's what the win-loss statistics actually look like over time. And this is 40 years of data, by the way. If you're not as analytical, you don't need to read every number. Just let your eyes scan it, because the pattern is obvious. The higher the seed, the higher the win percentage over and over again. So in the end, higher seeds consistently win, and it's not even close. So what do? We spend all this time analyzing the lowest probability outcomes, ignoring high probability drivers that would actually help us win, by the way. We chase Cinderella stories, trying to pick that one upset that makes us look like we game the system. And in doing that, we completely ignore the things that actually determine whether we win or lose, or at least the probabilities. So in bracket scoring, staying invested in the higher ranked teams matters way more than hitting some random first round upset. That's what actually drives the outcome, not whether you nailed the 12 seed beating a 5 seed. You want to focus on momentum, trend, probabilities that'll beat prediction over time. Whereas we like to say at our office, we are trend followers, not trend predictors, because nobody can predict what any stock, bond, fund, or what the overall market's going to do tomorrow, next week, next month, or next year for that matter. If this hasn't landed already, ironically enough, this is exactly the kind of behavioral trends we see in investing too. People have a tendency to focus on the long shots, the exciting ideas, what's really inexpensive, what's on sale. Oh, the stock's down a whole lot. I think it's I love the company, so I'm going to buy it. And they completely ignore what actually moves the outcome over time. And in the end, most often, unfortunately, it's the outcome that suffers as a result. Now, sure, there's going to be upsets, like I said earlier. There always are. But let me ask you this. Do you really want to build a retirement portfolio around the lowest ranked ideas? That's like building your NCAA bracket around 12, 13, and 14 seeded teams. It might feel exciting, but it's not a winning strategy for your bracket, let alone your retirement portfolio. And I've beaten this horse to death at this juncture, but at the end of the day, the odds favor the top seeds, and investing works the same way. We're constantly seeding ideas at our office based on strength and momentum. Again, wrong sport, but we want to stay invested in the playoff teams. We're not trying to diversify into all the teams. We want to stay invested in the playoff teams and avoid the rest. And the data tells us something really important, and that is that strong trends tend to keep trending, whether it's strength or weakness, by the way. Can lower ranked teams surprise us sometimes? Of course. One of the worst things that can happen is getting rewarded for a bad decision by chance. All that does is reward continued bad behavior and decision making. So we don't build portfolios on surprises. We build them on probabilities and repeatable outcomes. So discipline over excitement. That's the difference between something that works once or twice, for that matter, and something like probability that works over time. This year, I hope you went ahead and picked a Cinderella or two just to make it fun. Just don't lose sight of what actually wins in the end, because when it comes to your hard-earned life savings, retirement's obviously not a game. So maintaining your lifestyle, your financial future, it depends on it. So be intentional, because it's not worth diversifying into chance. And as always, there are thousands and thousands of podcasts out there. You chose to give ours a listen, so thank you so much for joining us, and we'll see you next time.
We hope you enjoyed today's episode. If you like a second opinion on your retirement plan or investment strategy, please head over to libertaswealth.com. This podcast is for informational purposes only and should not be considered as legal, financial, tax, or as a basis for investment decisions. Always consult a certified financial planner or a fee-only fiduciary advisor before acting on any ideas discussed.